The British pound is showing us how an energy crisis can very quickly transform into a currency crisis with the potential to become an outright financial collapse. What's up, guys? I'm Nobody Special, and last night the British pound hit its lowest level ever following back-to-back announcements of a new plan for energy bailouts and a new plan for tax cuts in the UK. And with that, we are going to shrink my big melon of a head. And let's take a look at this chart. This is the chart of the British pound going back the last couple of days. You can see that the pound was already in a rather steep decline from late last week. And then last night, in the middle of the night for us here in the States, the British unveiled their plan for a new round of tax cuts, and that sent the pound sharply lower. It has since recovered some of those losses, but the chart still looks pretty ugly for the British pound. And then here we go looking at this one. This goes all the way back to 1971, and you can see here last night it hit as low as $1.03, which is lower than the all-time low last seen in 1985. You can also see that in the US dollar index, or the DXY, which measures the strength of the US dollar against the euro, the Japanese yen, and the British sterling. And you can see here the Dixie is currently sitting at 114, continuing its march up and to the right that it's been on all year. So what is going on in the UK that's sending their currency down so sharply? Well, there's a couple of things, and the big one right now is energy. You may recall a couple of days ago I made this video called Europe's Economic Death Triangle, and it's all about how these three particular policies pertaining to energy were a recipe for outright disaster for Europe. And those three policies were price caps for retail customers, inaction on new energy supply, and bailouts, and how those three things combined were a recipe for infinite energy prices. When you put a limit on how much the retail customer pays for electricity and you do nothing to create new electricity supply, then you create a government-mandated shortage of energy. And then when you add unlimited bailouts to that mix, you create an infinite amount of money printing, sustaining higher and higher prices in energy, even though supply and demand never reach equilibrium because there's no demand destruction that takes place because of the price caps. It's an infinite feedback loop sending prices astronomically higher. And here we go, dated September 23rd in current news. Help is coming, says UK Chancellor Kwarteng, announcing a £60 billion price tag for energy support. Energy bill support will cost $60 billion for the 6 months from October, Chancellor Kwasi Kwarteng has announced. His speech to the House of Commons this morning announced his mini-budget, dubbed the Growth Plan, started with the energy crisis as he pointed to growing concern around the cost of energy and reports that bills could reach as high as £6,500 next year. To mitigate the crisis, newly appointed Prime Minister Liz Truss has announced three key support measures: the Energy Price Guarantee, i.e. price caps, the Energy Bill Relief Scheme, and the Energy Markets Financing Scheme, i.e. bailouts. Kwarteng today set out that this scheme is expected to cost £31 billion over its first 6 months. Now, the Energy Bill Relief Scheme provides support to businesses which were facing energy bill increases over 300%, according to research in early September. It caps electricity and gas unit prices for 6 months from October. This intervention is expected to cost £29 billion, bringing the total cost for both schemes to £60 billion. Now, right there is two sides of that economic death triangle. You've got price caps and you've got bailouts, and the third side of that economic death triangle was inaction on supply. Now, while Liz Truss has taken some action to secure supply, for example, here we go, dated September 22nd in Reuters, the ban on gas fracking in England is lifted in a push for energy independence that will allow some new gas supply to come into market in the UK eventually, but that's a year away at least, and there is no telling how much lawsuits from environmental groups, not to mention these imbeciles and their publicity stunts who smash gas pumps and chain themselves to trucks, who knows how much that would slow down any new energy supply. So at least in the short term, there is no new energy supply that's going to be coming into market in the UK. And so we have this recipe for infinitely higher natural gas prices. And if you look at what we've been seeing over the last few months, this is ICE Dutch TTF natural gas futures. This is the spot market for natural gas in Europe. And you can see these spikes are getting progressively worse every couple of months. The price for energy in Europe is going vertical, and it hasn't even started getting cold yet. It will very soon. So after decades of pandering to radical environmentalists, now we have an energy crisis going on in the UK, and we've announced basically an infinite money glitch to try to pay for it. That's one of the reasons why the value of the pound is in free fall right now. Now, the other reason the pound is dropping right now is because last night the UK announced a round of new tax cuts to try to address this crisis. And of course, this has sent the Keynesian economists around the world and the globalists that run the mainstream media just into an absolute outrage. Oh my goodness, how could anybody be talking about cutting taxes at a time like this? And here we go in the BBC, the pound hits record low after tax cut plans. The pound has fallen to a record low against the dollar as markets react to the UK's biggest tax cut in 50 years. The sterling fell close to $1.03 early on Monday before gaining some ground to stand at $1.08. Chancellor Kwasi Kwarteng has promised more tax cuts on top of the $45 billion package he announced on Friday amid expectations borrowing will surge. The cost of UK government borrowing climbed and markets speculated about an emergency interest rate rise. Some economists predict the Bank of England may call an emergency meeting as soon as this week to raise rates to help stem a fall in the pound and calm high inflation. If so, it would come less than a week after the Bank of England lifted rates by just a half a percentage point to 2.25% and before its next official meeting on November 3rd. And here you can see the surge in borrowing costs clear as day. This is the UK's 6-month bond. And overnight after the announcement of these tax cuts, the cost to borrow for 6 months increased by 150 basis points almost instantaneously, rising to 4.729. Now, while I think it's adorable that Keynesian economists are suddenly so worried about deficit spending now that we're talking about tax cuts, let's be honest here, folks. The pound was in free fall way before this tax cut was announced. Just look at this chart going all the way back to the global financial crisis, and here you go at the very end, there's your tax cuts. So after a decade and a half of near zero interest rates, infinite money printing, and Keynesian economists, now we get the announcement of a tax cut, which really isn't so much of a tax cut as it is canceling a planned tax increase. All of a sudden, everybody is saying it's the tax cuts that are causing this decline in the pound. Here's a hint, it's not. But that's not to say that lowering taxes while increasing spending is a good idea. This is something both Reagan and Trump got wrong here in the States. If you're going to cut taxes, then you need to lower government spending at the same time. Otherwise, you're just borrowing more money. And that's why we see these borrowing costs are expanding right now. Borrowing money is very inflationary. It increases the money supply. Money is created when loans are made. And so if the government is going to increase spending and cut taxes, that's a very inflationary move, and that's why the pound is falling even faster right now, causing some to think the Bank of England is going to slam on the brakes with their rate hikes. So now we can see how this energy crisis has spiraled into a currency crisis, with the pound losing value very fast. But now we're at the point where a currency crisis could very quickly become an all-out financial meltdown, because you have to keep in mind mortgages and the way mortgages are handled in the UK. First of all, check this one out. This is in Bloomberg, dated just this morning. Traders bet the Bank of England will hike rates by 200 basis points by November. That is a big rate increase. Keep in mind the US markets are in free fall right now because we just did a 75 basis point rate hike. Now they're saying the BOE could raise by 200. This will not be good for British stocks. Traders ramped up wagers on the scale of interest rate hikes by the Bank of England in the short term to deal with markets in turmoil over the government's economic plans. Money markets priced in more than 200 basis points of increases by the Bank of England's next meeting in November, 4 times the size of its last hike. The deposit rate currently stands at 2.25%. Now, this is where that gets interesting. Check out this one, also in Bloomberg today. The new rate shock will quickly slam millions of UK homeowners. The interest rate shock will quickly be felt by homeowners who need to refi their loans. The interest rate shock in the UK will quickly and directly hit millions of homeowners who are scheduled to refinance their mortgage. According to Neil Hudson, a director at Residential Analysts Ltd. And creator of BuiltPlace, roughly 1.4 million UK households are set to refinance their mortgages over the coming year. This is a substantial chunk of the roughly 9 million owner-occupied and 2 million buy-to-let mortgages that are currently in place. And here we can see the number of mortgages that are coming up for refi. They're nearing the end of their fixed rate period. Keep in mind, in the UK, they don't have 30-year fixed rate mortgages like we have here in the States. Here in the US, if we take out a mortgage at 3% interest, that 3% interest stays for 30 years. After 30 years, regardless of what the Fed does and what interest rates do, you're still paying 3% interest. Doesn't work that way in the UK. You get an introductory fixed rate, but then after 2 or 5 years, your interest rate expires and your house automatically refis at the current rate. Well, if interest rates are set to rise by 200 basis points, imagine what would happen to your mortgage payment if suddenly your interest rate were to jump up by 2 whole percentage points. Suddenly, you can't afford your mortgage payment. And this chart here is showing how many hundreds of thousands of mortgages are nearing the expiration of their fixed rate period and what their current interest rate is. Most of them are under 2.5%. They're about to go a whole lot higher. Now remember, folks, adjustable rate mortgages were one of the main ingredients to the global financial crisis back in 2008. So many people had bought homes at low interest rates, and as Ben Bernanke continued to raise interest rates to try to slow down the housing market, he didn't realize all of these adjustable rate mortgages were still on their teaser rates, and then one by one, millions of those adjustable rate mortgages started to expire, and they instantly refied up to the higher rate. Suddenly, millions of homes went into delinquency because people could no longer afford the payments. That's what is about to happen in the UK now, and it looks like it's about to get a whole lot worse if the Bank of England follows through with these 200 basis point rate hikes. So now you have to worry about the UK banks who are holding all of these loans that could go into delinquency if people can't afford the payments when they get refied. You're probably going to see a wave of homes hit the market, go up for sale, people trying to sell them because they can no longer afford the payments, only to realize the value of that home is now coming down fast as millions of people try to do the same thing. Suddenly, the sale price is a lot less than you paid for the place and you're underwater. This leaves the banks holding the bag, and that's how this energy crisis turns into a currency crisis and could very quickly turn into a banking crisis. Keep an eye on those UK banks if these interest rates keep rising. So what does this mean for us here in the States? Well, pretty much the same thing as that Japan story from last week. This means the US dollar is probably going to get even stronger relative to other global currencies. And even though that sounds like it might be a good thing for the States, it's actually very bad for U.S. companies. Remember, U.S. companies pay dollars to produce things, and then they sell them in overseas markets for pounds or for euros. Well, they have to convert that foreign currency back into dollars in order to report their quarterly earnings on their stock. So if the dollar is worth more money when they convert those pounds or euros back over to dollars, their earnings are going down even though they're still selling the same amount of stuff. So this is going to put downward pressure on the earnings of U.S. companies, and thus it means U.S. stocks are probably headed lower. This will also put more downward pressure on commodity prices as denominated in dollars. So that means more downward pressure on things like gold, silver, and oil. So long story short, what's going on in the UK right now is really just Europe's economic death triangle. As long as you've got energy price caps, as long as you've got no action on new energy supply, and as long as you've got bailouts in place, you've got a recipe for infinitely higher energy prices, and Europe and the UK will be forced to print more and more of their own currency in order to finance those increasingly high energy prices. That means more debt spending, which means more inflation, and central banks are going to try to fight that inflation by raising interest rates, which is going to cause suffering for homeowners and business owners alike. And while I am generally a fan of cutting taxes, the fact that the UK is cutting taxes while increasing government spending just means more debt and more inflation. Tax cuts only work if you also cut spending, and the UK has no plans to cut spending anytime soon. And if you want to know a little bit more about how this energy crisis has created Europe's economic death triangle, you can check out this video I did about how Europe is facing potentially infinitely higher energy prices this winter. Till next time, live small and dream big.